Let me show you something that should not exist in a functioning global market. Right now, at this very moment, silver is trading at two radically different prices in two different parts of the world. Not a small discrepancy, not a temporary blip. An 18% gap between markets for the same physical metal. In New York, silver is priced around $75 per ounce. In China, that same ounce is changing hands at $89. Same metal, same purity, same global commodity. Two prices, two realities. And before you dismiss this as just another market manipulation headline, I want you to stay with me, because what's happening here is far more important than silver. This is about how global markets actually break. It's about what happens when the machinery that normally keeps prices honest simply stops working. And if you understand this moment, you'll understand something most investors never do until it's too late. This isn't about telling you what to buy or sell. This is about recognizing a once-in-a-generation fracture, a moment when the connective tissue of the global financial system tears apart. When arbitrage fails, when paper prices detach from physical reality, when two truths exist at the same time. These moments don't happen often, but when they do, they change everything. To understand why this matters, we need to start with something very basic, something markets rely on every single day to function properly. That mechanism is called arbitrage. In normal market conditions, arbitrage keeps prices synchronized across the globe. If silver is cheaper in one market and more expensive in another, traders instantly step in. They buy where it's cheap, sell where it's expensive, and pocket the difference. This process happens automatically, constantly, and at massive scale. It is why you don't see gold trading at wildly different prices in London and New York. The moment a gap appears, capital floods in and closes it, like water finding its level. This is why large price discrepancies for globally traded commodities are supposed to be impossible. The system is designed to eliminate them. Arbitrage is the invisible hand that keeps markets efficient, honest, and connected. But right now, that hand is gone. Let's look at the actual numbers, because this isn't theory, this is math. As of December 29th, 2025, the COMEX spot price for silver in New York is hovering around $75 per troy ounce. That's the number flashing on Western trading screens. But now look at Shanghai. On the Shanghai Futures Exchange, the front month silver contract closed at approximately 20,230 yen per kilogram. Convert that to dollars using the current exchange rate, about 7.3 yuan per dollar, and you get roughly 2,140 per kilogram. Divide that by 32.15 troy ounces per kilogram, and the result is clear, $89 per ounce. $75 in New York, $89 in China, a $14 gap on a $75 asset, an 18% premium. In a healthy market, this gap wouldn't survive for minutes, let alone days. Traders would buy every ounce available in New York, ship it to China, and sell it for an instant, risk-free profit. Do that enough times, and prices converge. That's how markets are supposed to work. So why isn't it happening? The answer explains everything. The arbitrage bridge is broken, and it's broken by design. In exactly 72 hours, starting January 1st, 2026, China implements a new export licensing system for silver. This isn't speculation, it's law. Once it goes into effect, silver can flow into China, but getting it back out becomes bureaucratic, uncertain, and in many cases impossible without government approval. In practical terms, silver entering China becomes trapped. Now think about what that does to arbitrage. A Western bank could still buy silver at $75 in New York and ship it to Shanghai, but once it asks there, the bank is stuck holding yuan inside a system with strict capital controls. Worse, if something goes wrong, they can't easily repatriate the metal. No export license, no silver back. That $40 spread suddenly isn't risk-free anymore. The risk premium explodes, capital gets trapped, liquidity gets frozen, and the arbitrage desks, the very mechanism that keeps global prices aligned, simply shut down. Without arbitrage, markets don't converge, they drift apart. What we're witnessing right now is the emergence of two separate silver markets, operating under two different rules. One is a paper market anchored to derivatives and thin holiday liquidity. The other is a physical market anchored to real-world supply, industrial demand, and imminent legal restrictions. This is why this moment matters. Even if you've never touched silver in your life, when markets break like this, they expose truths most people never see. You learn how fragile price discovery really is. You learn how dependent the system is on trust, flow, and liquidity. And you learn that when physical reality and paper claims diverge, one of them eventually loses. What makes this situation even more unusual is which price is higher. In every major speculative bubble in history, tulips, dot-com stocks, housing, crypto, the paper price runs ahead of fundamentals. Speculation inflates valuations beyond reality. But here, the opposite is happening. The physical price in China is higher than the paper price in New York. That's called an inverted premium, and it's extremely rare. It means real buyers, industrial users, manufacturers, refiners, are paying more than speculators. They're not chasing momentum. They're securing supply. They're locking in metal before it becomes unavailable. And timing is everything here. Today is December 29th. We're in what professional traders call Ghost Week, the period between Christmas and New Year when liquidity evaporates. Senior traders are on vacation. Risk managers are offline. Institutional desks are running skeleton crews. The market looks open, but it's hollow. In normal conditions, selling 1,000 silver contracts barely moves the price. There are plenty of buyers. But during Ghost Week, that same order can smash through the order book like a wrecking ball. Prices don't drift, they gap. Not because fundamentals changed, but because there's nobody there to absorb the flow. This creates what AS, known as a liquidity air pocket. And it explains why prices can suddenly collapse without warning. Now, ask yourself this. If you were a major institution, knowing that China's export restrictions go live in 72 hours, knowing that institutional money floods back into markets on January 2nd, knowing that silver is up over 160% this year and facing a structural supply deficit, what would you do? You wouldn't chase prices higher in thin markets. You'd do the opposite. You'd use Ghost Week to flush liquidity. You'd push prices down just enough to trigger stop losses. You'd force weak hands out. You'd buy what they sell. And you'd position yourself before the real volume returns. This isn't conspiracy. It's strategy. Stop losses, those safe protective orders retail traders rely on, become weapons in thin markets. Banks can't see your individual order, but they can see clusters. They know where liquidity sits. And during Ghost Week, triggering those levels creates a cascade, automatic selling that feeds on itself. That's exactly what we're seeing now. Silver didn't fall because the fundamentals changed. It fell because the market structure allowed it to be pushed. Zoom out, and the picture becomes clear. Silver started 2025 around $29. Even at $75, it's still up over 160%. A pullback after a move like that isn't a crash, it's a test of conviction, a test of understanding. Ask yourself, did new silver mines suddenly come online this week? Did China cancel the export restrictions? Did industrial demand vanish overnight? No. Only the price on the screen changed, and that price is being set by thin liquidity, not reality. The Shanghai premium is the smoking gun. If silver were truly worth $75, China wouldn't be paying $89. Industrial buyers aren't speculating, they're hoarding. They're securing inventory before January 1st, when silver inside China effectively stops flowing out. That tells you everything you need to know about which price reflects reality. And when these two prices converge, because they must, the adjustment won't be gentle. Markets don't slowly fix $14 mistakes. They snap, they gap. They reprice violently when liquidity returns and physical constraints assert themselves. This is how delivery squeezes begin. This is how paper credibility collapses. This is how suppressed prices suddenly leap. Not because of hype, but because metal disappears. What you're watching right now is not panic. It's preparation. In part 2, we're going to break down exactly how this gap closes, why COMEX inventories matter more than headlines, and how institutional money positions itself before the snapback. Because when the market realizes $75 was a lie, it won't ask permission to reprice. It will just move. Now that you understand why the $14 gap exists, we need to talk about the only question that actually matters. How does this end? Because markets cannot tolerate two prices for the same physical asset indefinitely. One of them must give. Either Shanghai collapses down to New York, or New York snaps up to Shanghai. And once you understand the mechanics, it becomes clear which outcome is far more likely. Let S start with a simple truth most retail traders never learn. Paper markets only work as long as physical delivery is trusted. Futures contracts, ETFs, derivatives, all of it rests on one assumption, that when someone demands the real thing, the system can deliver it. The moment that assumption comes into question, prices stop behaving politely. Right now, Western silver markets are dominated by paper claims. COMEX contracts represent far more silver than actually exists in deliverable form. This has always been the case, and under normal conditions, it works, because very few people ever stand for delivery. Most traders roll contracts or settle in cash, but this time is different. China's export restrictions change the entire flow of physical metal. Roughly 20% of global refined silver production becomes effectively locked behind regulatory walls. That metal doesn't disappear, but it becomes unavailable to Western markets at the exact moment industrial demand is accelerating. That creates pressure, not on charts, but on inventory. COMEX inventories are not infinite. They're not theoretical. They're physical bars sitting in registered vaults. And when large players see a $14 discount relative to Shanghai, they don't buy futures to flip for dollars. They buy futures to stand for delivery. This is already happening. Inventory drawdowns don't make headlines, but they matter more than price candles. Every ounce that leaves a comic's vault tightens the spring. Every delivery request stresses the system. And when inventory falls fast enough, confidence cracks. Here's where things get dangerous for paper pricing. If too many contracts demand physical delivery at once, COMEX faces a choice: deliver metal or cash settle. And cash settlement is the moment the illusion breaks. Because the entire purpose of a futures exchange is physical credibility, the second participants believe contracts won't be honored in metal, the market loses legitimacy. That's when price gaps appear, not because of buying pressure, but because selling disappears. No one wants to sell silver at $75 when Shanghai is paying $89. No miner, no refiner, no sovereign buyer. Sellers vanish, bids chase higher prices, and the adjustment happens in hours, not weeks. This is why price convergence is rarely smooth. Markets don't walk toward equilibrium after structural breaks, they jump. Now, layer in timing. We're at the end of Ghost Week. Liquidity is artificially thin, price moves are exaggerated, but also misleading. What looks like weakness right now is often accumulation disguised as volatility. Institutional money doesn't chase green candles in thin markets. It waits. It lets price be pushed down. It absorbs supply quietly. And then, when full liquidity returns, when desks are staffed, when allocation committees meet, when January capital rotates, the real move begins. January is not just another month. It's rebalance season. Pension funds rebalance. Sovereign funds rebalance. Commodity allocations reset. And capital flows toward what performed best in the previous year. Silver is up over 160% in 2025. It is mathematically impossible for large funds to ignore that. When that money hits a market already facing a physical bottleneck, price doesn't drift upward, it gaps. This is why the Shanghai premium matters more than any Western chart. Shanghai is not a speculative playground. It's an industrial pricing center. Solar manufacturers, electronics producers, battery supply chains. These buyers don't care about RSI or moving averages. They care about availability. And right now, they keep screaming one message: we don't care what the paper price says, we need metal. That's why they're paying $89. This also explains why the current pullback is not bearish, it's a stress test. Weak hands exit, forced sellers liquidate, stops get cleared. Meanwhile, strong hands absorb supply. This process is uncomfortable by design. It transfers ownership from emotional participants to strategic ones. Every major commodity supercycle has this phase. In the 1970s, gold didn't move smoothly from 35 to 850. It collapsed multiple times along the way. Each drop shook out believers, each recovery left fewer sellers behind. Silver followed the same path until it exploded. The mistake most people make is assuming volatility means invalidation. In reality, volatility is confirmation in supply-driven markets. Now consider what happens next. January 1st, export restrictions go live. January 2nd, full institutional liquidity returns. January 2nd onward, price discovery resumes under new constraints. This is not about hype, it's about mechanics. The West is pricing silver as if supply is flexible. China is pricing silver as if supply is scarce. One of those assumptions is wrong, and physical markets always win that argument. This doesn't mean price goes straight up. There will be more volatility. There may be one last shakeout. There may be headlines designed to scare participation. But the direction of resolution is not random. Markets don't stay disconnected forever. When they reconnect, it's violent. And that brings us to the psychological trap. Most investors fail not because they're wrong, but because they exit right before resolution. They sell weakness created by structure, not fundamentals. They react to red candles instead of asking why those candles exist. This moment is the exam. Can you distinguish between a real breakdown and a manufactured one? Can you tell the difference between price discovery and price distortion? Can you hold conviction when the screen contradicts reality? Because the people who understand this aren't panicking right now. They're preparing. In next Paradox, we'll break down what happens if delivery stress accelerates, why volatility will increase, not decrease, and how smart money positions itself after these dislocations resolve. Because when the $14 lie collapses, it won't collapse quietly. It never does. At this stage, the most dangerous mistake anyone can make is assuming that once prices reconnect, volatility disappears. That assumption is wrong. In reality, volatility accelerates after reconnection, not before it. The calm does not return when the gap closes. The calm disappears permanently. To understand why, you have to understand what a price gap like this actually represents. It is not just a numerical difference. It is a disagreement between systems. One system is paper-based, highly leveraged, optimized for liquidity and speed. The other is physical, slow-moving, inventory-constrained, and governed by logistics and regulation. When those two systems diverge, price becomes unstable. When they are forced back together, stress is released. The $14 gap between New York and Shanghai is not simply an arbitrage anomaly. It is a warning signal that the market's internal plumbing is under strain. Pipes are narrowing, valves are closing, and pressure is building behind the scenes. Once export restrictions activate and liquidity returns, the market faces a problem it cannot solve gently. Too many claims chasing too little metal. This is the point where price no longer functions as a discovery mechanism. It becomes a rationing mechanism. In rationing environments, prices don't move to fair value. They move to levels that force behavior. They move until demand is destroyed or supply is released. And when supply is structurally constrained, as it is now, price has only one job: reduce demand by making participation painful. That's when people say markets are broken. But markets aren't broken. They're doing exactly what they're designed to do under stress. The real damage occurs elsewhere. The first casualty is confidence in paper settlement. When participants suspect that contracts may not be honored with physical delivery, behavior changes immediately. Traders shorten time horizons, investors shift vehicles, institutions reduce exposure to instruments they can't trust. This is subtle at first. Volume shifts, inventory drains, delivery notices increase, then suddenly, trust collapses all at once. We've seen this pattern before. In nickel, in natural gas, in lumber, in sovereign bond markets. Every time the narrative is different, the mechanics are identical. Once confidence erodes, liquidity vanishes on one side of the market. Sellers step back, bids chase, prices gap, halts appear. Volatility spikes not because of speculation, but because no one wants to be the last seller of a scarce asset. Silver is uniquely exposed to this dynamic because it is both monetary and industrial. That combination is rare. Gold is monetary, but not industrial. Copper is industrial, but not monetary. Silver sits at the intersection, and that makes dislocations far more dangerous. Industrial users cannot simply stop buying silver. Solar panels, electronics, medical devices, defense systems all require it. Demand is not discretionary. When price rises, they do not exit. They secure supply. That is why Shanghai matters. The Shanghai price is not emotional. It is not speculative. It reflects procurement behavior. Buyers paying $89 are not betting on charts. They are locking in inputs before access becomes uncertain. This is the mistake Western markets continue to make, assuming all demand behaves like investment demand. It doesn't. Industrial demand is price insensitive until it becomes unavailable. At that point, price becomes irrelevant. Availability becomes everything. That is when markets move vertically. Now let's talk about what happens after reconnection, because this is where most people get blindsided. Once prices snap closer together, there's a tendency to believe the event is over. It isn't. Reconnection is not resolution. It is transition. After reconnection, three things usually happen simultaneously. First, volatility expands. The market must now operate under new constraints. Old ranges no longer apply. Risk models break. Stop placements fail. Algorithms recalibrate. This creates violent intraday swings even in the direction of the dominant trend. Second, participation narrows. Weak hands are gone. Forced sellers are exhausted. What remains are strategic holders and institutional allocators. Liquidity appears higher, but it is thinner in reality because sellers are scarce. Third, narratives shift. Media coverage changes tone. What was once ignored becomes debated. What was once dismissed becomes framed as systemic. This attracts new participants at precisely the wrong time, late, emotional, underprepared. This is when most retail participants lose money, even if they were directionally correct. They buy strength, they sell fear, they overreact to noise, they underestimate duration. The professionals don't. They understand that once a market exposes a structural flaw, it does not revert to its old behavior. The flaw remains. The system adapts around it, but trust never fully returns. This is why dislocations like this matter beyond price. They reveal who controls flow, who controls inventory, and who absorbs risk when things go wrong. Right now, the answer is clear. Physical holders control inventory, and paper participants absorb risk. That imbalance does not correct smoothly. It corrects through pressure. This brings us to the most important point of the entire series. This is not about silver. Silver is simply the instrument through which a larger lesson is being taught. The lesson is that global markets are fragmenting. Regulation, geopolitics, capital controls, and national priorities are breaking the assumption of frictionless flow. Assets are no longer globally fungible in the way models assume. We are moving from a world of unified pricing to a world of regional scarcity. In that world, price gaps are not errors, they are signals. Signals of stress, signals of hoarding, signals of mistrust. Those who understand this early adjust behavior. Those who don't get forced to adjust later at worse prices. This does not mean panic, it means clarity. The mistake is reacting emotionally to volatility instead of structurally to change. The next phase will not reward speed. It will reward patience, capital discipline, and understanding of mechanics. If prices overshoot, they will correct violently. If prices dip, they will be bought quietly. If volatility explodes, it will not mean failure, it will mean transition. This is how markets behave when assumptions break. The $14 gap was the warning shot. Whether it closes in days or weeks matters far less than how it closes, and all evidence suggests it will not close gently. So the question is not, where does price go next? The question is, do you understand why price is behaving this way at all? Because once you understand that, fear disappears, confusion disappears, and decision-making improves dramatically. That is the advantage institutional players operate with. Not certainty, but structure. As this situation continues to evolve, remember this. Markets do not move to punish you. They move to resolve imbalances. Your job is not to predict every move. Your job is to avoid being forced out at the worst possible moment. That is how capital survives periods like this. And survival is the prerequisite for opportunity. If this breakdown helped you see the mechanics instead of just the headlines, share it with someone who is reacting emotionally to price instead of understanding structure. If you want continued analysis focused on systems, flow, and pressure, not hype or predictions, subscribe so you don't miss the next update. And if you found value here, a simple like tells the algorithm this kind of analysis matters. The gap was never the story. The break in trust was.